Good morning from our global headquarters in New York City. I'm Danny Berger. Manish Cranny is off this week. You're welcome to Bloomberg Brief. Let's set your agenda. Surviving the House Republicans pass a spending bill, teeing up $4.5 trillion in tax cuts. A new tariff threat. President Trump signs an executive order to investigate copper tariffs. And after 4 days of declines, stocks brace for Nvidia earnings after the bell. And those 4 days of declines, it is the biggest for this market since early September. Mag 7 enters a technical correction. We rebound this morning. Nvidia, you can see there, bottom of your screen, up 2.5% just about before their earnings after the bell. So NASDAQ leads the way after falling the most yesterday. S&P 500 futures, those are up 0.5%. Can Nvidia put a stop to the bad news? We are hyper attuned to consumer data. The Conference Board's consumer confidence indicator hitting an 8-month low that seemed to set off markets yesterday. It also meant that yields were lower for bonds yesterday, pricing in more than 50 basis points of cuts by a year. And that's the first time we've signaled a more dovish path than the dots. But yields are moving higher again. It is an attempt to reverse some of the action we saw yesterday. We have a long way to go, though, if we want to do that. Both 10-year and 2-year up by about a basis point this morning. Your 2-year yield hovering around the lowest since early October. 10-year yield around the lowest since early December. Some individual stocks for us to keep our eye on this morning. Supermicro, that is surging in the pre-market session. The company had filed its outstanding financial reports to regain compliance and stay listed on the NASDAQ. Those shares up 26%. Shares of AB InBev in the European trade, those are soaring the most in 3 years. Let's get a look at that. Those shares up 6.7%. U.S. beer market, that showed signs of recovery, a key market for them. There was increased marketing and sales of its biggest brand in the region. Elsewhere in the London trade, Aston Martin, those shares falling more than 10%. It cut its profit target for 2025. It also plans to trim its workforce by about 5%. The luxury car maker is struggling to reverse years of losses, but I will say it did have the coolest unveiling in the F1 event the other week. The drivers coming out to the James Bond theme song. That was pretty cool, but clearly not enough to make people buy Aston Martins. Okay, coming up this hour, we're going to be catching up with Ed Cole of Man Group. And live from Cape Town at the G20 Finance Minister Summit, Ireland Finance Minister Paschal Donohoe will be joining the program. But first, the minerals deal has been agreed to. Ukraine is said to have agreed with the U.S. to jointly develop its natural resources, including critical minerals, oil, and gas. The step may pave a way towards a ceasefire with Russia. Ukrainian President Volodymyr Zelensky is traveling to the U.S. on Friday to seal the deal. President Trump said he's welcome to.
I hear that he's coming on Friday. Certainly, it's okay with me if he'd like to, and he would like to sign it together with me, and I understand that's a big deal.
For more, let's bring in Bloomberg opinion columnist Mark Champion. So, Mark, the deal, it seems done?
Yes, it seems like it's done. It has moved from where it was when Ukraine said that it couldn't sign. We don't know all the details, but it seems like on sort of big ticket items that the figure of 500 billion is gone, and there's something probably closer to 100 billion in terms of what the U.S. should get out of this deal. But the structure seems about the same. It's a fund that will be jointly owned, with 50% of revenues going to the U.S. In the end, it's probably a deal that Ukraine wouldn't sign unless it had to. There are absolutely no security guarantees in there, which is what with the original idea when President Zelensky put forward the idea of all these resources that Ukraine had that would be available to its allies. That was the purpose. So there are no security guarantees, just the sort of implication that the U.S., once bonded in economically, will support Ukraine.
Why doesn't it have those security guarantees, Mark? It was our understanding that Zelensky had said just the presence of American business in Ukraine wasn't enough, that wasn't enough assurity that the U.S. would have its back on security issues.
I think, as I said, I think that it's a matter of the Ukrainians understanding that ultimately they have no choice. They desperately need the U.S. support, military and financial support. The Europeans can't fill that gap. They're capable. They're fighting on. They're capable of fighting on. They believe that they have to be able to carry on in order to get the kind of peace deal that they can accept with Russia. So this is a sort of lesser evil, accepting a deal from President Trump and just the word of the U.S. And from President Trump that they will get support for as long as it takes, although President Trump was very unclear on how long that would be. He simply said, maybe until there's a peace deal.
Meanwhile, we have the visits coming to Washington, D.C. I mentioned Zelensky will be arriving on Friday. Before that, you had Keir Starmer, you had Macron also meeting when it comes to Ukraine and to European defenses. Does there seem to be some cohesion among the Europeans? We learned yesterday that the UK will be spending more, or aims to spend more of their budget on defense.
Well, they seem to be taking a similar stance, the UK and France, in the sense that they have decided that the best, the most prudent action is to come to Washington, try and stroke President Trump's ego, essentially, and to do some of what he wants, which they do understand and have understood for some time, but they do understand needs to happen in any case. They're trying to show willing and hoping that they'll be able to keep the U.S. bonded into Europe until such time as Europe actually does have the strength and the security forces to be able to defend itself without U.S. aid.
Okay, Mark, thank you very much for that update. That is Bloomberg Opinion's Mark Champion. Now, speaking of the spending and defense spending, G20 finance ministers and central bank governors are gathering in Cape Town to discuss that and other matters about the state of the global economy. Bloomberg's Jennifer Zabazaja is live in Cape Town with a special guest. Good morning, Jen.
Yeah, morning to you, Danny. I am live with Ireland's Finance Minister, Paschal Donohoe. He's also the Eurogroup president. Thank you so much for joining us, considering a lot of the circumstances. Danny was just talking about defense spending and how we're seeing a shift in defense spending and allocating funds for that. The EU is looking to potentially loosen fiscal rules to reallocate funds to defense. What is your take on that? How far should it go?
So the European Union is already a very significant contributor to the defence of Ukraine and to the security of their economy. But you're right, there's now an intense discussion underway regarding how we can further contribute to that defence and security. And the first phase of that is within our existing budget rules, what flexibility can be used to allow countries to increase their national defence expenditure. The Commission President flagged this as an option there around a week ago, and the Commission and ministers are now working together to understand precisely how we would make this happen. But it appears to me to be a very reasonable and sensible way of addressing the need of how we can better fund Europe's security.
Do you think this escape clause, though, should be part of the discussion, or are you concerned potentially about this?
Well, we're talking about flexibility inside the existing rules. And the reason this flexibility was put in was to deal with risks, was to deal with difficulties that could grow in scale. So I do think it is appropriate that while maintaining our budget rules, we look at how they can be used to deal with an issue that is, after all, existential, our security and the future of Ukraine.
So you don't think it's unreasonable then? I wonder how you feel about the U.S. then asking Europe to rethink their own contribution to defence as part of NATO.
Well, we're already aware of the need to increase our own defence expenditure. In Ireland, for example, we've now been significantly increasing our expenditure in defence and security. We're a neutral country, but we know we need to invest in our own security, and we are planning to further increase that spending in the years ahead. And many of my colleagues within the European Union are on the same path. And even though the US point is obviously very important, given their gigantic contribution to NATO, we're aware of the need to do this anyway because of the way in which the world is changing.
You said further increase over the next few years. What are you looking at potentially?
So in Ireland, for example, we have a plan to get our defence expenditure up to €1.5 billion. It has increased by 30% since 2020. And if I look at other colleagues across the European Union, they're now looking at what the further increases are that they they need to put in place. The level of that increase does vary country by country, but I'm certain in the very near future you'll see those spending plans go up, reflecting the challenge we now have to confront.
Do you think there should be a certain type of financial instrument that should be decided on when thinking about this? We've heard a few different countries maybe potentially tinkering with different ideas. Do you have an ideal mechanism?
So I think it's inevitable that different options will be looked at, but I think our first port of call should be what we can do at a national level while maintaining financial stability and maintaining the integrity of the budget rules. And the main reason why I would make that point to you, that's the thing we'll be able to do the quickest. We are going to, no doubt, look at new instruments, look at a debate regarding how we can fund our future better. But all of that will take a little bit of time, whereas we know at national level we can do more, and how that can be coordinated better at an EU level is also an important debate we need to have.
And Minister, I imagine as part of the discussions here, there's a lot of talk about tariffs and the potential effect on your own individual economies, but also as a bloc. What have those discussions been at this point between you and your country?
So the vast majority of countries who've been participating in these discussions have some very clear messages. Trade, while of course it brings with it many different challenges, trade inside a rules-based order remains the single best way in which we can lift national economic performance and global economic performance, while also strengthening our safety nets, looking after citizens at times of big change. And therefore, any attempts or any moves that can bring in tariffs really do have the potential to harm trade, harm jobs, bring up prices, decrease investment. And while we very much understand why this has been put on the table by our colleagues and friends in the US, of course we want to negotiate with them to see are there alternative ways in which we can deal with the issues they're raising.
Do you worry about individually as a country, Ireland, potentially getting caught in the crossfire of this, especially if you consider the trade situation between the US and
So any small, open, trade-intensive economy, the Irish economy and many other ones that are here, of course we are concerned about the effect that a change in global trade and the broad application of tariffs could have on our national economy, and many other ministers will feel the same.
Have you expressed that to your U.S. counterparts here? I mean, the U.S. counterpart is not here, but the officials.
Oh, there are U.S. officials
Yes.
who are here, who are hearing those different messages from many, many different countries. We're in a fortunate position where we have a current high level of strength within our national economy. Our economy is growing. We have a record number of people at work. We have many different engines of national economic growth. But our concern is a global one. Anything that really begins to change how global trade happens, we believe would be mutually harmful. And we would prefer to work together to get the agenda towards something that could be mutually beneficial, recognising the serious issues that many countries are raising on behalf of the people they serve.
Are you optimistic, though, considering a lot of the confluence of challenges that are going on right now?
Well,
you're talking about some of what you've heard this morning.
Well, I always make the case for optimism.
Sure.
I always believe we can make progress. Of course, I have to acknowledge that we are facing many, many demands and difficulties at the moment. We're all aware of what they are. The debates regarding global trade, what could happen with tariffs, the effects of wars. But I really believe that our South African friends and hosts here today have reminded us of the value of the G20 and how collaboration and dialogue can still play a vital role. And many of us, including Ireland and Europe, are all in on that and want to play our part in finding the opportunities and dealing with the really severe challenges we know exist.
All right, we have to leave it there. Minister Paschal Donohoe,
thank you very much.
Ireland Finance Minister and also Eurogroup President, was just telling us also this is the first time Ireland has been invited to the G20, so joining us here on set. Danny?
Jen, thank you so much. What a fantastic and timely conversation. Bloomberg's Jennifer Zabajajia at the G20 Finance Ministers meeting. I want to bring you some breaking lines from just moments ago. BP having their capital markets update. And we have here a reversal from BP. They will be spending $10 billion a year on producing more oil and gas. Just to give you a reminder, a mere 5 years ago, they had planned to cut oil and gas by 40% spending by 2030. Instead, again, they will be spending $10 billion a year on more oil and gas. They will also be slashing their spending on renewable energy. They'll be selling some $20 billion of assets. They've been under pressure from activists activist investor Elliott Management. Shares are lower by 1.5%. That is most likely because of a dramatic cut to their buyback from $175 billion to as little as $750 million a quarter. That is going to be a painful move. But again, it is a U-turn, spending more oil and gas and slashing their share buyback. Okay, more to come. You're watching Bloomberg Brief. Welcome back to Bloomberg Brief. I'm Danny Berger in New York. President Trump's plans for early action on tax cuts saw their chances improve yesterday. House Republicans passed a budget blueprint which calls for deep cuts in safety net programs like Medicaid. Joining us for more on Washington is Bloomberg's Josh Galou. So, Josh, the big, beautiful bill gets through the House. What does its life look like beyond this? How will this appeal to perhaps more moderate senators when it faces issues like deep, deep cuts to programs?
Yeah, this bill barely got through. So only in the end, one Republican voted against it, and all Democrats voted against it. But it was really a last-minute thing, and that really underscores the problem here. It's going to be a narrow path for Speaker Johnson to get this bill through. Now it goes to the Senate. It's a trimmed-down budget plan, but it calls for $4.5 trillion in tax cuts over the next decade, which is an extension of President Trump's 2017 tax cuts that are set to expire at the end of this year, plus additional tax cuts. It calls for about $2 trillion in spending cuts. Most of that is going to come from social programs, safety net programs. That is going to be a really difficult thing to sell for many Republicans who come from districts that have very high use of Medicaid, food assistance, and premiums for the Affordable Care Act that are paid. So it's going to be a tough, whatever comes back from the Senate, it's going to have some changes that are going to be tough for the House Republicans which are already under pressure to stay united behind this thing. It's going to be a lot of back and forth, and it's not clear that this is going to make it over the line. But in any case, this is going to add to the deficit over the next decade. And you have those fiscal hawks on the Republican side that are really not happy about that.
Well, you also have an argument that perhaps one of the aims of tariffs, of the many we've seen, is to raise revenue. And Josh, on this front, another day, another executive order with an investigation, this time around possible copper tariffs. What do we know?
Well, Trump signed an order to have the Commerce Department investigate the possibility of copper tariffs and whether that's an area that he should impose additional levies like he's doing with aluminum and steel. Those are set to kick in next month, I believe. Again, this is part of the same plan about viewing these things as raising government revenue, and the notion that the suppliers from other countries are paying them. But it has been an issue that U.S. copper production has declined over the years. And there are questions around whether there's overcapacity in the global supply, whether some countries might be dumping and depressing U.S. production. But most of that comes from the Americas. So Chile is the biggest, the U.S. imports the most from Chile, and Peru, Mexico, Canada. So, it's unclear whether, first of all, there's a timeline for this investigation to go through, but it's also clear that, Trump is ready to pull any lever he can when it comes to tariffs. He likes those. And this one allows him to do it under the sort of guise of national security, because weapons makers are, for instance, highly dependent on copper, and they're importing it all. So we'll have to see what happens with that. But I think we've already seen that Trump is not shy from putting down tariffs on metal imports.
Yeah, we still need to wait for those to come through. Steel and aluminum tariffs, those are due on March 12th. Josh, thank you so much. Bloomberg's Josh Galou. And just to give everyone a timeline, Auto chip pharma tariffs, those are due April 2nd. Reciprocal tariffs due early April. The delayed Canada and Mexico tariffs, that ends on March 4th. And as I just said, those other metal tariffs come on March 12th. Okay, coming up, shares of Stellantis getting a hit, battling slow demand while searching for a new CEO. Those shares down 3%. We'll discuss next on your brief. Let's take a look at the front pages this morning. First up on the Bloomberg, Stellantis seeing little improvement in profitability this year after a 70% slump. They're guiding for a mid-single-digit adjusted operating income margin. That compares with 5.5% last year. They're also still struggling to find a new CEO. Next up, the FT leads with Israel wanting to extend the Gaza ceasefire when it expires this weekend. Talks for a second phase have stalled, and a U.S.-backed extension is currently being considered. Both sides threatening a return to fighting if their demands are not met. Also on the Bloomberg this morning, the White House, strange one here, revealing that Amy Gleason, a healthcare tech executive, is actually the acting administrator of the Doge team. That means that Elon Musk does not hold the legal role of Doge head, even though it does appear that the billionaire is directing its activities. The White House said in a recent court filing that Musk is a senior advisor to President Trump and not a Doge employee. Coming up on the show and later today, it's the big one. We're going to be pushing ahead to Nvidia earnings and the state of markets. We'll be catching up with Ed Cole of Man Group. Stick around for that. That comes up after this break. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Surviving the House Republicans pass a spending bill, teeing up $4.5 trillion in tax cuts. A new tariff threat, President Trump signs an executive order to investigate copper tariffs. And after 4 days of declines, stocks brace for Nvidia earnings after the bell. And that fourth day of drop in the S&P 500 marks the biggest decline since September. Mag 7, that is in a technical correction. It seemed like it was consumer confidence that sent us there. The Conference Board's indicator hitting an 8-month low. We attempt a rebound this morning. S&P 500 futures up 0.5%. NASDAQ 100 outperforming. Net Nvidia, that is also higher in the pre-market. Will it save us in terms of its earnings today? Yields do move higher this morning, but yesterday it was pricing in more odds of a cut. We priced in more than 50 basis points. That's the first time we've done that this year. Your 2-year yield and 10-year yields moving up by about a basis point. Your 2-year yield, that is around its lowest since early October. For the 10-year, early December. So it is Nvidia Day. Happy Nvidia Day to all who celebrate, which if you're watching this show, I am certain you are one who does. The stock is still down year to date. All eyes are on data center demand after DeepSeek made investors question AI capex earlier this year. Joining us with a preview of the results, Tamlin Basin of Bloomberg Intelligence. Tamlin, great to see you this morning. What are we expecting?
Yeah, so I mean, as you pointed out, this is the first earnings post DeepSeek, and really what we're looking at is demand holding up from those cloud service providers, the hyperscalers, Meta, Google, Oracle, AWS, Microsoft. Are they continuing to invest heavily in these GPUs and continuing to drive this explosive revenue gains for Nvidia? So we'll be looking at 4Q, are they hitting those targets? And also, what is the guide on revenue and on that data center segment going into 1Q? And I think there's going to be a lot of focus on that. Is it going to match investor expectations?
There's been a lot of back and forth on this point, specifically, Tamlin. We had that TD Cowen note the other day saying that Microsoft would be pulling back on some of their data center leases. But the information reporting this morning that Meta is also discussing a $200 billion AI data center project. Where do we stand on our understanding of how much CapEx is being spent on AI and therefore into Nvidia?
Well, a lot is the underlying answer. Microsoft, we look at that as more of a recalibration of their spending on the AI centers. And then that report on Meta today was a $200 billion potential data center that they're going to be building. And this is really all tied to sort of that AI evolution. What we have seen also, Google has upped its CapEx. This was also following the DeepSeek. So as of now, we are still seeing from these companies strong demand in AI and in data centers. So I think there's going to be a lot of focus on what Nvidia has to say. Obviously, these cloud service providers make up at about 50% of their data center revenue. So it's going to be interesting to see how that has played out over the last quarter and what they are hearing from their customers going forward into 2025.
Tamlin, appreciate it. We'll see what those earnings bring after the bell. Tamlin Basin there of Bloomberg Intelligence. I'm pleased to say that joining us now in person is Edward Cole, head of multi-strategy equities at Man Group. Ed, so great to see you. Thanks for coming into the studio early.
Thank you for having me.
So it's been a rough ride. Mag 7 down on the year, now in a technical correction, as is Nvidia down on the year. How important is today? Can this stop the pain of the overall equity market?
So I think it's been a tough year in that group. It's been a pretty good year in lots of other things, right? I think we've become fixated in markets on this narrow leadership, which has been getting ever narrower for such a long time. But, you know, if you sit outside that very narrow universe, which is a big part of the S&P, it's been a great year for Europe. It's been a great year for China. It's a great day for China today.
Yeah.
So I think there's a lot more going on in markets than just what's going on in the Mag 7. I think that's a healthy thing, to be honest. I mean, we've seen extraordinary levels of earnings revision, positive earnings revisions over the last 2 years for the Mag 7. I think the forward earnings estimates moved up about 90%, which is about 10 times the rest of the S&P 493. That naturally focuses attention a great deal, but there are other things going on. And in my mind, there are actually more interesting opportunities today than focusing on a narrow number of growth stocks.
Fair enough, but that also brings up the question of how you actually view what's happening with this sort of vibe shift. Because people have pointed to it, along with what's happening in bonds with yields coming down and saying, this looks like something of a growth scare. Is it something of a growth scare, or is it just a rotation? Is it just a pullback of some of the over-optimism we had coming into President Trump's second term?
Yeah, so, I mean, I think the last 5 years has been unbelievably confusing. And I honestly, as I look at the data that's come in over the last 2 weeks, it remains unbelievably confusing. I mean, I think you look at the US economy today, and there's elements of it that look a bit too speed. You know, there's some weakening of data on the services side. The labour market we know is fine, but actually at the margin, there are things still weakening in the labour market. Private hires is really not running at a particularly healthy-looking number. And then on the other side, you've definitely got manufacturing momentum. Now, that's a really small part of the market, and it's a small part of the economy, but it's pretty important for cyclicals. And there's been a run of better data in things like sort of faster moving components of the OECD leading indicator. The ISM manufacturing's been doing well. The recent PMI manufacturing's doing well. So you've got this kind of slightly weird two-speed thing going on. My bias is to think at the moment that, you know, broadly the economy is slowing down. I think there's still a tightening going through if you think about what's happening with the stock of mortgages resetting at higher rates. So the policy rate doesn't matter perhaps as much here for the economy as just the slow grind of repricing of credit through the economy in corporates and households. And so I think kind of, you know, medium term things are slowing, but in the near term you have this weird opportunity, I think, which is that cyclicals look pretty interesting. I mean, we talked about this when I was on with you a few weeks ago. I think, you know, the dollar, probably a weak dollar is going to support that. But even just what looks like the beginning of a restocking cycle, which drives manufacturing, and then deep cyclical earnings normally do pretty well in that environment. So ever the contrarian, unfortunately, that I am, I think, like, if I had to kind of think about reducing that to thinking about would I rather own Russell 2000 or NASDAQ here, it would be Russell 2000 for me.
Even if there's a Fed that doesn't cut as much as expected?
Yeah, I think so. I think there's a case here that actually you get that manufacturing, you know, upswing, inventory restocking cycle, which is good news for kind of cyclical earnings where, you know, operating leverage is kind of bigger in those companies. So the delta they feel from that is quite gives them a lift. And then, you know, we probably are in a stickier inflation environment. So inflation generally is something I think, you know, you best play through cyclical companies rather than long duration things.
I'm interested in the cyclical idea also because of the policy mix we're getting out of the White House. I wonder how important it is for that narrative. The idea that we were excited that there'd be tax cuts and deregulation. The order of things, though, has been tariffs and some fiscal tightening, at least when it comes to DOJ's efforts. How important is it to you that you see some of the tax cuts, the deregulation come to pass in order to get that cyclical upswing?
So I spent the best part of 20 years doing emerging markets, which felt like a lifetime, and you carry a lot of scars from that experience. And the reason I think that's relevant is that what I learned during that period, I definitely didn't learn how to sleep. But what I did learn...
You probably still don't sleep, so that's a lesson I think worthwhile.
What I did learn through that period is that our capacity as investors to really fully understand government policy is quite poor. You have a lot of headline type, policy promises that that markets react to, and I think they treat them or try to treat them in the same way that that they would a single name, corporate announcement. So there's an attempt to kind of always discount that information and arrive at a price. And a good example of that would be the conviction over the strength of the dollar when we knew there was a red sweep. Everyone was all in, complete conviction that this would be a strong dollar environment, which we're now seeing the cracks open up in. And I think it's therefore pretty difficult to look at policy like, DOGE or tax cuts and translate that when you have so many different policies moving at one time. I think it's quite difficult for markets to understand exactly what that means, and also how long it's going to take for those things, even if they do happen to feed into a different, perhaps, regime when it comes to nominal GDP.
I had a conversation with another hedge fund manager that was of a similar ilk, but basically he said it's frustrating to him because he has these convictions and trades that he wants to put on, but they keep getting disrupted by what you're talking about, by all the headline volatility. Do you find the same frustration that you have ideas that make sense, but just the volatility and trying to digest gets in the way?
Yeah, I mean, it's really hard, but, the market's right. We're not. That's the bottom line here is I think that you have to be, and this is the strange thing about this job, is that you have to have a sufficient level of conviction that that what's going on to participate in the market, and a sufficient level of humility to accept when your thesis just isn't playing out. And that's probably happening more at the moment than it would otherwise. The other way, of course, to deal with that is, and the kind of, the kind of way we approach it, is just try not to take big macro bets. I mean, one of the consequences of that conversation you had is there's a lot more dispersion, there's a lot more volatility. Those are good things, but it's better perhaps to be waiting to be able to pick things up that have been shaken out by that kind of volatility rather than trying to bet on macro outcomes through single securities.
I think everyone in your industry should watch back what you just said. This feels like a good therapy session for everyone. I think we all need it. And I just want to end on this because you had this in your notes and I thought it was really fascinating and I don't want to leave without getting to it. But this idea that Japan and Japanese investors have been a big source of liquidity, and you're concerned about the staying power. Just what are you looking at?
How long have you got?
1 minute, Ed.
1 minute. So I think in simple terms, Japan's one of the biggest surplus economies in the world. They park those surpluses, of course, in overseas assets. Inflation is high in Japan. Inflation expectations are becoming unanchored. I think the Bank of Japan's capacity to continue to intervene to buy JGBs is pretty limited now. Their balance sheet is enormous. It's 125% of GDP. The Fed's is 25% of GDP. If they continue to intervene to buy bonds, they're going to depreciate the yen. It's going to feed into inflation. So my sense of what's very likely to come, and we have a big statement from the GPIF, their biggest pension fund, next week on their asset allocation, is we're going to see Japanese institutions start to move capital home. I think they will probably be instructed to buy more, or they will change allocation to buy more Japanese stocks. If they're also changing it to buy more Japanese bonds, that will be very interesting. And I think it would serve a purpose of capping the yen, underpinning the yen, capping yields perhaps. And the implication there for global liquidity is that there's been this big household carry trade in Japan where Mrs. Watanabe, as she's referred to, has been funding her purchase of US growth stocks from selling an ever-weakening yen.
Right.
And if the yen side of that changes, I worry a bit. Not perhaps as catastrophic as August last year, but that kind of dynamic could play out.
You're right. We probably do need more time to talk about this. All the reason for you to come back on, Ed. Please join us whenever you're in New York. Otherwise, we will speak to you in London, I'm sure. Ed Cole there of Man Group, thank you so much for joining us. This is Bloomberg. Welcome back to Bloomberg Brief. Danny Berger here in New York. House Republicans have passed a budget blueprint which calls for deep cuts in safety net programs like Medicaid. It also boosts President Trump's plans for early action on tax cuts of about $4.5 trillion. Joining us for more on this is Bloomberg's Josh Gallo. So, Josh, we got the tax cuts just narrowly passing the House.
Just narrowly, and we'll have to see what happens when they go to the Senate. This is really the beginning of a long road for Speaker Johnson to drive this through. So this blueprint has $4.5 trillion worth of tax cuts over the next decade. It would, prolong the Trump tax cuts from 2017, which are set to expire at the end of this year. And it would add to the deficit. The federal spending cuts that it calls for are in the range of $2 trillion. And it isn't entirely clear what is going to be cut. That's what's going to obviously be the biggest problem here. Most of the cuts are aimed at programs that are like social safety nets, Medicaid, and this is going to be a problem for the Republicans. They only had a very narrow majority to pass this in the House. Everyone but one Republican ended up voting for it. But when it goes to the Senate, you're also going to it's going to get some changes, and those changes are also going to be pushed back around these cuts because many of these people come from districts or areas that have quite a few constituents who are on Medicaid or who receive food assistance or other programs or benefit from other programs to help the poor and the disabled that come from the government. So they're going to be slow to recognize those cuts. If, at the same time, if you don't have those cuts, there's a provision that's going to take down the amount of tax cuts that are available. And we'll just see where it comes out because Johnson is going to have to get on board a lot of fiscally conservative Republicans who are not very keen about a growing budget deficit over the next 10 years. He's going to need their votes to put it through.
Josh, elsewhere, we had President Trump talking and announcing a program that gives a path to citizenship for those who offer to pay $5 million. There already is a path for a green card privilege if you invest a certain amount into the U.S. How would this differ?
Well, the EB-5 visa program that you're referring to is something that's been designed to essentially target investment. It's an investment. It's an investment in an area that is impoverished or needs job growth, or even a specific company that would lead to job creation. I think the level of investment is around $1.8 million. That's required, and then depending on the area, if it's a very needy area, it can be smaller, closer to $1 million, and that would then give the investor a path, green card rights, and a path to citizenship. What Trump is proposing now is really different. Commerce Secretary Lutnick said this is not really necessarily an investment of $5 million, obviously considerably more money, but it might just be money that's paid directly to the government to help pay down the deficit. So it's unclear. Trump has sold this, or he billed it yesterday as something that would bring wealthy people here who are going to spend money and create jobs and invest. But there appears to be no such requirement for this gold card. You can just buy it straight from the government.
Josh, thank you very much for that update. We appreciate that. As Bloomberg's Josh Gallo. Now, 3 years after the Russian invasion of Ukraine, Ukraine has struck a deal with the U.S. that may help lead to peace. Ukraine is said to have agreed with the U.S. to jointly develop its natural resources, including critical minerals, oil, and gas. Ukrainian President Volodymyr Zelensky is planning to travel to the U.S. on Friday to sign the deal with President Trump, who has said that he's welcome.
I hear that he's coming on Friday. Certainly, it's okay with me if he'd like to, and he would like to sign it together with me, and I understand that's a big deal.
For more, let's bring in Bloomberg opinion columnist Mark Champion. Mark, what do we understand about the contours of this deal?
Right. So this has been under negotiation. Obviously, it was proposed to President Zelensky in Ukraine. He rejected it. There was a big war of words between President Trump and Ukraine. And that seems to have settled down. We got to a negotiation in which some of the kind of really standout lines, from what we understand, have been kind of ameliorated. So no longer $500 billion that Ukraine is supposed to provide to the U.S. Out of its resource and infrastructure revenues, more like we think $100 billion. Some of the other language has changed, but the key element here is that there are still no security guarantees, which was the reason in the first place why Zelensky proposed to Ukraine's allies that they could take some kind of interest in Ukrainian resources. So it's a deal that Ukraine is signing because they have to, because they need and still need U.S. military support to survive.
Then we have Zelensky, as I mentioned, traveling to the U.S. to meet with President Trump reportedly on Friday. We heard from the president there, Trump, saying that he would welcome such a meeting. If they're having to concede on certain parts of this deal, Mark, does it look like a setup for an agreement to end the war that looks like it's more on the U.S. and Russia's terms?
Well, absolutely. So this deal is really, it's just between the U.S. and Ukraine. This is what President Trump wants, to be able to, to be willing to continue to support Ukraine, financially with military aid and so on. And he may have needed it, after all he said, to sell that deal to supporters at home, because he said a lot about ending the war and, all the wasted money, etc. But what impact it has on, negotiations with Russia, that's quite unclear. The U.S. still hasn't said that Ukraine, immediately would have a seat at the table. It hasn't had one yet. It's talked about maybe eventually having one. And it's not clear how this deal would impact the talks with Russia, other than to, allow for more time, which is very important. So more time in which Ukraine could sustain its armies in the battlefield, more time to get a better agreement with Russia, provided that President Trump is willing to press for it.
Mark, we really appreciate that update. Thank you so much. That is Bloomberg Opinion's Mark Champion. Again, Volodymyr Zelensky will be heading to the U.S. to meet with President Trump on Friday. Before that, the UK's Keir Starmer will also be in Washington, D.C. Coming up, Nvidia results. They are front and center in your day ahead. We'll lay out the calendar for you on your Wednesday. Let's get you set up for your trading day on this Wednesday. The main event, Nvidia earnings, those will occur after the market close. But first, we will get some data, U.S. home sales. That comes at 10 a.m. Eastern. We'll also have $44 billion of 7-year Treasury notes that will go on auction at 1 p.m. Some stocks to keep an eye on as we head into the pre-market trade. Freeport-McMoRan, those shares jumping as President Trump signed an executive order that might open the door to tariffs on copper. Those shares up more than 5%. Workday, those also extending post-earnings gains. Pre-market up some 13%. It beat the street's expectations. Evercore analysts said that the results were what, quote, bulls hope to see. And here's the one to set you up. The stock you got to wake up and check this morning. It is Nvidia. Those shares are up 2.5%. But just to give you the context of where we've come from and what the bar might be, we have seen Mag 7 decline 10% from the highs, entering something of a technical recession. We were just speaking with Ed Cole earlier, who said, yes, that might be hurting the overall market, but the Man Group portfolio manager mentioned that it has been a rotation under the surface, and he still likes cyclicals. Okay, that is it for Bloomberg Brief. The team at Surveillance will take things from here.